Hey, it's Mike Lynch with AmeriFirst Financial, and it is the week of January the 24th. It's Monday morning, and it's time for your Monday morning mortgage update. Hope everybody had a great weekend. So I don't watch a lot of football games, and I usually listen to them on the radio, but I cannot believe the games this weekend. 4 games and some of the best football games I have ever seen. So if you're a football fan, you were not disappointed no matter which team you were voting for. But I have to say, Niners did it again. I'm not sure how they did it, but they eked out a win. And so we're off to LA next week. So hopefully your team won. Let's talk about last week and what's happening this week in the mortgage market, mortgage rates, and what's really going to move the market this week. So last week, mortgage-backed securities pricing, and I talked about this on Monday, started off just diving off a cliff, down 60 basis points on Monday. And so what that means is when mortgage-backed securities or the basis points go down, mortgage rates go up. And this is when trading in the bond market for mortgage-backed securities. But then the week came to fruition and we rallied, and all of the losses that we had on Monday were gained back by the end of the Friday. So we ended the week flat, really no change to rates. But that doesn't change the fact that since January 3rd, which was the first day of trading after the new year, we have seen over a 200 basis point drop in the mortgage-backed securities market, which means rates have gone up anywhere from 0.375 to 0.5% on most mortgage programs. So what we've been really discussing with our buyers and our sellers and our borrowers is, hey, what you looked at or what you were approved for at the end of last year, you need to reevaluate your payment. You need to reevaluate where the market rate is. Does that change what you can afford? Does it put you in a different price bracket? So it's a great reason to contact your leads, the people that you haven't talked to in a month or two, and just say, hey, let's do a refresh. Let's look at where you are. They need to connect with their lender. If they're not getting solid information from the lender, be more than happy to help in any way possible. So let's look at this week and what's going to move the market, what's going to look at changing rates. So the 3 things, we're looking at the Fed, we're looking at inflation, and we're looking at economic growth. So the Fed's first Fed meeting is tomorrow, ends Wednesday, and then the Fed will come out with a report or a news reporting that'll basically tell them what they talked about, what their policy is, what they are going to do moving forward. And so typically the first meeting in January is not that impactful of a meeting, but not this one. This one's very impactful because of what has been happening the last 2 months, which really is a lot of movements with the Fed, a lot of questions that the Fed has to answer. Will the Fed stop buying mortgage-backed securities sooner than later? Will they have rate hikes? When? How many rate hikes will they have? What do those rate hikes look like? Will they dump the money out of their balance sheet? Will they do quantitative tightening? Just a lot of questions. So what does all that mean? So we know the Fed last year said, hey, we're going to stop buying mortgage-backed securities. They've been buying mortgage-backed securities in the billions and billions of dollars since COVID started. We knew this wouldn't last. This is why rates have been so low, and they're going to stop doing that. They said, hey, we're going to do this tapering. We talked about this. It's going to end in June. But then they said, you know what? We got to move that up a little bit. We're going to probably stop in March. Now there's some reports that they may stop buying mortgage-backed securities, truly accelerate the reduction of buying mortgage-backed securities by the middle of next month, by February. Why are they doing this? So they can increase the Fed rate. They can have rate hikes on the Federal Reserve rate. Now, when you hear in the news, hey, the Fed's raising rates, the Fed raising rates, that's the Federal Reserve rate. And that affects credit card debt, home equity lines, auto loans, all of that. That affects those rates. It does not have a direct impact on mortgage rates. Mortgage rates, as we all know, are determined by the trading of mortgage-backed securities in the bond market. But when the Fed hikes their rate, you hear about it in the news. Everybody thinks that's going to raise everything, but it doesn't necessarily raise those mortgage rates, but it does have an indirect impact. So if the Fed's going to raise the rate in March, let's say, why would they do this? to combat inflation. They have to combat inflation. It's runaway. So the Fed will raise that rate to combat inflation. Are they going to raise it a quarter point, a half a point? Are they going to do one rate hike this year? Are they going to do four? It's all over the place, a lot of different opinions. So what the Fed says on Wednesday is going to be very impactful. So the Fed stops buying mortgage-backed securities, but they're still reinvesting in the mortgage-backed securities market. But now they've talked about maybe stopping that reinvestment or really backing off on the reinvestment in the mortgage-backed securities market as much as $2 trillion this year. That means the Fed's going to get even more out of the mortgage-backed securities market. And unless other investors, your 401ks, your IRAs, foreign investors, unless they start putting money in that mortgage-backed securities market, the bond market, this could drive rates up as well. And then there's quantitative tightening. Quantitative tightening is basically when the Fed reduces the pace of investments in bonds and hikes rates. They curb the money supply. Why are they doing all this? It's all around inflation. So that's our second thing, inflation. On Friday, the PCE reports coming out. So Fed's favorite measure of inflation, expected to be above 4.8%. Now, the Fed is in violation of their mandate. Last year, they had a mandate that said they would keep inflation about 2%. Well, they haven't. They have put their head in the sand. They've had a bunch of smoke and mirrors saying inflation wasn't a big deal. It is a big deal. We've all known it's a big deal. We're seeing it in our pocketbooks. We're seeing it at the store. We're seeing it in the amount of supplies we get for the same price, all types of inflation, wage inflation, fuel inflation, everything else. And this 4.8 really is a high number. It's the highest we've seen since the 1980s, what's expected. And that's driving up rates. Inflation is horrible for rates. So one of the ways that the Fed offsets the effects of inflation is to hike their Fed funding rate, they curb spending, and that can lower inflation. So we're going to feel some pain in the short term, but long term, this is better for the economy. So the third thing is economic growth. We're going to see the GDP this week. It's going to show how our economy grew in the fourth quarter of 2021. Will this be a good number? Will it be an average number? Anything above 2% is not good for rates. We do expect it to be up above that, but a lot of things happened in the fourth quarter. Omicron, retail sales were down. And so will this have a negative impact on that GDP growth? If the number is strong, that means rates are going to go up. So what are we doing this week? We're floating into Wednesday, going to probably move into a lock position and stick with that for the rest of the week. Unless there's some major geopolitical event, something in the Ukraine that really disrupts everything and causes a lot of concern and fear, we really expect rates to move up this week. So have a great week. If you know anybody that can benefit from this video, please forward. If you have any comments or questions, I'd love to hear them. And if you have any clients that just need some insight on rates and what to do, don't hesitate to reach out to me. Have a wonderful day, and we'll talk to you soon. Bye-bye.